Hey everyone, welcome back to my channel. I hope you're all doing well. So last week the markets ended in red, and looking at this heat map, you can see that a lot of ETFs were down 2 to 4%. And if we pair that with the October effect, as we know, October is the most volatile month in the year, we might actually get some buying opportunities. So in this video, I'm going to talk about 3 top ETFs I'm targeting for October. So looking at the first ETF, it'll be an options income ETF. The next one will be a dividend growth ETF. And the final one is a leveraged income ETF. And if you stay until the end of the video, I'll give you a bonus ETF that I'm looking at. Okay, so let's start with the GPTY, which has exposure to artificial intelligence and technology. As of October 13th, some of its top holdings include NVIDIA, Palantir, Microsoft, Google, and Meta. So, looking at some of its specs, currently it distributes about 33% every week and generally pays on Fridays. Now, it does have exposure to 15 to 30 holdings, but it doesn't run option plays on all 30 holdings every week. Now, looking at its distributions, what I do is I take the weekly pay values and I add it up all to make it look like a monthly value. And for me, that's just easier to understand because it helps me budget what I can use that money for, like paying rent, traveling, or covering other expenses. So if we look at June's value, it paid $1.24 per share. In July, $1.22. August, $1.50. And in September, about $1.31. So if you had 1,000 shares and you received $1.31, you would have received $1,310. Now, looking at August's distribution, it's higher than the others because in some months there are actually five distributions. So it's kind of a bonus, but not normal. Now, if you look at the charts, you can see that in orange, GPTY is outperforming all other three ETFs, including Chippy, AIPI, and QQQI. Now, one time I did have AIPI in my living off dividends portfolio, and the income was pretty good. It covered all my living expenses, but the nav just didn't recover to its 2024 high. So I got rid of it thinking that someday there might be another ETF that provides tech exposure but just does a little bit better job than AIPI. And I think I may have found that in GPTY. Now, looking at the 1 month return, you can see that GPTY is up about 7.72% in total return, but Chippy is not that far behind. And I think Chippy is actually more popular than GPTY, although they both haven't been out for a long time. So I could see investors looking at both Chippy and GPTY. Now, if we look at the 6 month return, again, GPTY is outperforming QQQI, IP, and Chippy. Now, looking at the charts, you can see that in April, it did dip to about $33. In September, it dipped to about $44. And last week, before the dip, it touched about $48.55. So right now, my buying range is somewhere between $44 and $48. So if I have some GPTY targets, you can see that at $45, that would give me a 33% yield on cost, $42, a 35% yield on cost, and if I buy some shares at $40, it will give me a 37% yield on cost. I actually think it won't dip down to $40, so I think right now the range is somewhere between $42 and $45. Okay, so let's move on to the next ETF, CGDG. This is a global large equity blend, and some of its top holdings include Broadcom, which is AVGO. And I always think that if SCHC kept this one, SCHC would actually perform a lot better, but it is what it is. What I like about CGDG is its top holdings are a little bit different than other portfolios. It has like Airbus, has RTX, it even has Welltower, which is a REIT. So it has a pretty interesting mix, and that's why I'm interested in adding more of this to my portfolio. Now, if we look at some specs, it is a dividend growth ETF, so it's not a high yielder. But when we look at the 2% dividend yield, you have to really think about, well, what does 2% mean? because 2% of $1 million is different than 2% of $10. Right. So if you had the choice, would you rather have 2% yield off of $1 million or 10% yield off of $10? You would choose a 2% yield off of the $1 million. So that's why the yield is a relative yield, and you really have to think of the actual share price. So although it's quite low right now, I think in 5 to 10 years, it actually might be some pretty good income. Now, this is a quarterly pay, so it pays in April, July, October, and December, and it currently has about 102 holdings. So we look at the distribution rates. It's still a relatively new ETF. It started in 2023, and that 10 cents was just one distribution. It didn't include all four dividends from that year. But in 2024, it rose up to 63 cents per year. And in 2025, I'm still waiting for Q4. I'm estimating somewhere between 16 and 18 cents. So that would take that up to about 70 cents to end of the year. Okay, so looking at the charts, I chose some popular dividend growth ETFs such as SCHD, DGRO, and VYM. And you can see that in orange, CGDG is outperforming all of them. Now, if we look at the 1 month return, you can see that DGR is doing pretty good, but CGDG is down a little bit. And I think maybe this is a pretty good discount to take or a good dip. But we look at the 6 month return. CGDG is up 15.43% compared to, let's say, VYM, which is 13.5, and DGRO, which is at 14.8. So you can see it's doing pretty good. And year to date, still CGDG is the king. So I really have high hopes for this. Again, it's sort of a newer ETF, but I think this is going to outperform some of the popular ETFs that are on YouTube right now. Okay, so let's take a look at the charts. CGDG did dip to $28.02, and I'm still kicking myself because I did buy some shares at that price, but I sold them too quickly. Um, it took another dip around $33.82 around September, early September. And then last week, it touched about $34.97. So my buying range is somewhere between $34 and $35. I don't think it'll dip under $33 again, but I could be wrong. So some of my CGDG targets right now, if I buy some shares at $34, that'll give me a 2% yield on cost, $32, 2.1% yield on cost, and $30, 2.3% yield on cost. It would be great if it dipped down to $30, but again, I don't think that's going to happen. So somewhere between 32 and 34 is my target. Okay, so let's move on to the last ETF, NVDW, Computing Infrastructure. And this is a leveraged income ETF, so it does things a little bit different than normal covered call ETFs. Now, it currently has an 84% distribution rate, but again, I'll talk about that later. It's a weekly pay, so it pays on Wednesdays, and it only has three holdings. It has some exposure to NVIDIA, a money market fund, and some swap agreements. Now, looking at the distribution rates, you can see that in June, it paid about $1.65 per share. In July, $2.27 per share. August, which is the biggest month I've seen so far, $3.37 per share. And in September, $1.75. August is pretty abnormal, so I think the average is more somewhere between $1.75 and $2.27. So, if you were in July and you had 1,000 shares, you'd get $2,270, which is pretty sweet for NVDW. Now, if we look at it in comparison to some other leverage ETFs, it is doing a lot better than Microsoft and Amazon and Meta. You can see that in green, NVDW is about 8.2% in total return. So pretty good, but again, none of these funds have been out for more than a year. So this data isn't that reliable. It just shows the last 2 to 3 months. But if we look at this 1 month return, although I am targeting NVDW because I've always wanted to get or have some exposure to NVIDIA, if I look at the discount, like the value, maybe Amazon looks like a good buy right now. I know it's down 11.32%, but some people say that Amazon is undervalued right now and it could pop, especially if the Santa Claus rally comes up, maybe more interest rates and some other factors. Amazon could be a good buy right now. But right now I'm looking at NVDW, so maybe I'll make a video about that later. So looking at the charts, you can see that before July, somewhere around that time, it dipped to $43. Around September, $45, and then last week it touched $50.57. So my range is somewhere between $45 and $50. So my NVDW targets right now, if I can get some shares for $47, that'll give me a 48% yield on cost. $46 will give me a 49% yield on cost. And then if I get some shares at $45, a 50% yield on cost. So earlier I said I talk a little bit more about that 87%. Sometimes I don't understand where they get that 87%. Some weeks it might actually be 87%. But when I calculate it using my yield on cost formula, some weeks it's actually just kind of closer to 50%. And for me, I'm completely happy with that because I think some ETFs that try to have a yield of, I don't know, more than 80%, sometimes they have problems with their NAV decay or control. So I think maybe that's one of the reasons why NVDW does pretty well because the distribution rate isn't like ultra high. So for me, that's one of the reasons why I like NVDW more than other leverage ETFs. Okay, so let's look at the summary. For GPTY, my price targets are somewhere between $42 and $45. And this is a short-term play, and it's mainly for covering my living costs. CGDG, my price target is between $32 and $34, and this is a more kind of long-term play. And NVDW, my price targets are somewhere between $45 and $46, and this is a midterm play. Okay, so you've made it to this far in the video. Congrats. Here's the bonus. It is EGGY, EGGY, and it has exposure to US large cap companies. And it's a Nestio dynamic income ETF. It's not as popular as like Roundhill or Yield Max, but some of its ETFs have done pretty well in the last few months. Currently, it has an 18% distribution rate, but you know me, I don't trust the yields because they don't tell me enough information. I really need to see how much that 18% is paying me. So I'll talk about that in just a few moments. But it is a monthly pay, so you don't get paid every week, and you generally get paid at the end of the month. And it does have 52 holdings. If we look at some of its top holdings, you can see App 11 in there, Broadcom, Coin. It even has Netflix and Lilly. So it has a lot of different stuff. I really like that it has Oracle. I feel like some ETFs that I'm interested in don't have Oracle. And I think, well, Oracle probably still has a long runway. So this ETF is pretty interesting to me. Now, if you look at the distributions, again, this hasn't been out very long, so it still has a lot to prove. But the monthly distributions in June were about 81 cents. And you can see that in July, it hovers around the 80 cent distribution rate. But if you look at the months before this, it was around 70 cents. So I don't know if that's dividend growth, but it seems like this fund is doing pretty well. Now, if we look at the performance, and I chose some things that are kind of popular on YouTube, we have KQQQ, T-Spy, QDVO, OMA, and Nefli. And you can see that, well, I know it's kind of hard to see, but in blue, EGGY is actually outperforming most of the funds out there. And if we look at the performance chart, you can see that Aggie at the bottom, 3.61% in the 1 month return compared to KQQQ and QDVO. Minefli is down negative 2.88%. But that's because they've had some news in the past month, so Netflix is down quite a bit. But if we look at the 6 month return, it tells a different story. You can still see that Eggy is up 33.88%, and it's doing better than QDVO and KQQQ. So that's pretty amazing. And I think it might even pay a higher dividend. So Eggy seems like a hidden gem for me. You can see that Netflix is not far behind. Now, interestingly, year to date, Netflix is actually the king. It's actually beating all of the funds that you see. So I think Netflix is also a hidden gem. I know it's a yield max fund, and a lot of people don't like yield max for some reason, but some of its funds are doing pretty well. But Eggy is not far behind, and so I'm looking at both Netflix and Eggy to add to my portfolio. Okay, so looking at the charts for Eggy, you can see that it dipped to $30.74 in April. September, $37.18. And I'm just showing you the two big dips that have happened this year. Last year, or not last year, last week, it touched $41.15. So my buying range right now is somewhere between $38 and $41. So if we look at some price targets, $39 would give me a 25% yield on costs. 38 would give me just a little bit higher at 25.8%, and $37 would give me 26.5% yield on cost. So remember, I said earlier in the video, it's published to be 18%, but it really depends on what you bought your shares at, and then how they're doing, on their option plays or whatever income strategies that they're doing that month. So it fluctuates, but if you can buy Eggy at a discount like right now, and they do pretty good on their income strategies, then you can get a higher than 18% yield on the shares. And so that's why I'm looking at Eggy right now. Okay, so that's the end of this video. Hope you got a little bit of value. I just wanted to share some ETFs that I'm looking at for my portfolio. I hope you can use some of this for to do more research for your own portfolio. And if you're looking for other videos on how to generate income and how to live in Asia, please like this video and subscribe to watch more free content on achieving financial freedom and living in Asia. Thanks very much, and see you in the next video. This video is for entertainment purposes only. It is not intended as financial advice. Consult with a qualified financial advisor before making any investment decisions.